Welcome to a special edition of Market Pulse from Equifax, where we break down what's shaping the mortgage industry today and what happens next.
Hi, I'm Clayton Collins, the CEO at Housing Wire, and we are here at MBA Annual 2025 for a pretty legendary conversation. This may be the first time, at least my first time, bringing together leaders from the 3 nationwide consumer reporting agencies to talk about what's changing in data in the mortgage process. Joel, Michelle, Satyan, thank you so much for joining us today. So Joel, I want to kick off with you with kind of your view on why data is so important in today's mortgage ecosystem, and how you're thinking about the landscape that is just the talk of the town here at MBA Annual 2025.
Well, first I want to say very much thank you so much, Satyan and Michelle, for joining us. I think it's important for everybody to know we are vicious competitors. I mean, outside of this time right here, we're going to fight to earn our business with each and every customer, and we all come to the table with our unique offerings and our unique differentiators. So that's the first thing I want people to realize. But more important, all of us are here today because we actually stand united that more data is better for the consumer. And that starts with all 3 credit reports, and then that expands out on all the differentiated things that all 3 of our organizations are doing to bring to the industry with the single objective of how do we help more people qualify for the loan. That's what it's really about, where there's so much conversation about how do we reduce data. That's how you eliminate people. We're looking at an inclusive approach of how do we get more people qualified today. So I think we all share that, and the fact that we're all sitting here together is representative of that united goal.
Michelle, do you feel the same way? Vicious competitors?
Well, yeah, I can't agree more on that. I mean, it's all day, every day. And I totally agree also. Our mission is financial inclusion for all. And so we spend all day, every day, not just competing with these guys, but also working really hard to make sure that we can fairly represent all consumers and give everybody the chance to home ownership if that's what they want.
All right, Satyan, on the topic of vicious competition, it's been disclosed by each of you that there are major differences between your credit files and the data you report. Can you jump in and give us a view on the differences that you see between the data, and start with your organization, TransUnion?
Sure. Yeah, thanks. I think one important fact when it comes to the 3 national bureaus is we don't see each other's file, which makes that an even harder competitive landscape, right? I cannot inspect Michelle's file or Joel's file, so I really have to work with my teams to do what we think is the best thing to add to our bureau data, and it's something that, for those that aren't aware, we have. I can speak to myself. Me and my team are the face of the mortgage business and also the auto business, but we have large amounts of people whose job is every day in and day out, to source more information, more data on the file. And one thing I want to add here is the file is just becoming more and more diverse. Like, we can talk about this a little bit more, but there are so many new, different, unique financial lending products that I think the world right now is as differentiated as a file as we've ever seen.
What's an example of the new data capabilities or features of the file?
Sure. So for one example would be the buy now, pay later lending product. Okay. So the Affirms of the world. We work through CDI and industry organizations to talk about how to get something standard on that on the file. But at the same time, it's really up to the furnishers to decide when, how much, and to whom they furnish. And so again, we compete very ferociously about getting getting as much data as we can on our reports.
Yeah, Michelle?
Yeah, no, absolutely. The goal is to give as much representation to consumers as we can. And so whether that's through rental payment history, whether it's through how consumers manage their cash flow, whether it's through alternative financial services, whether they be short-term loans or things like buy now, pay later, like Satyan was just talking about, I agree. Like, the files are more diverse now probably than they've ever been.
I think about it from overall contributors. If you think about 5-10 years ago, the number of people contributing data to a credit file today has gone up 3x.
Yeah.
And it's all of the things that my peers here are talking about. It's different type of contributors. And so you have not only the difference in financial contributors, but then you also have the additional data around, are they paying rent, like Michelle said, or do they have utility information that we can add? Because the new scores will take that into account and help improve that look of the customer.
These may be differentiators that you understand and that mortgage lenders may understand, but consumers likely not. Consumers probably have a very little or no recognition of what the difference between Experian, Equifax, and TransUnion is. And that probably goes for a lot of loan originators and real estate agents and other people who advise consumers. How do we take a step forward in consumer education for them to understand why 3 consumer reporting agencies exist and how they aid in credit? Joel, if you want to kick us off there.
Well, sure. It all comes down to education. And I think one of the things you hear about in the mortgage industry today is the shopping behavior and how conversions have dropped. Part of that is because of a lot more applications for folks that are just looking to see whether they can apply or qualify, and or if they could save a few bucks on a refi. Part of that could be addressed through education. The other part is getting those people that get denied the first time enough education on how to improve their score and their trade lines and those type of things to be able to qualify. And it all comes down to the data. Without the data, you don't have a score. And without a score, you don't go anywhere in the process. We talked a little bit yesterday on one of our sessions about one of my children that, would love to buy a house. And now his dad needs to help him get better about having credit history so he can do so.
If your children need education, then what are the rest of us?
My goal is by the end of this session, we're going to get him a loan. Anyway, it's that education to help him understand what he needed to do to get those additional trade lines so that he had a score so he would be considered.
Yeah, I'll jump in and say, I can speak for TransUnion. I think this exists with all the bureaus. It's Michelle's comment earlier. It's about getting access to credit, access to homes. TransUnion works a lot on that consumer education, free credit scores, download our app, right? To be able to really understand what a consumer can do to change and what changes they can make to make themselves mortgage eligible, right? And so there's a lot of education there that consumers do need to continue to build on. And again, with this proliferation of different products, you think about a younger generation and maybe their first experience with credit is, in a firm loan, right? To understand what does that mean? What does that mean to go apply for a credit card? There's a lot of education that consumers need, but at the end of the day, this was a comment that was made in a session earlier yesterday. The credit score in mortgage is I just think of that as like the doorknob to get in. It's just the front door. It's actually the data that we've been talking about that is used for the underwriting. The GSEs don't actually use a score in their underwriting. All they use is the data and the trended data that was pioneered about a decade ago, right? Which is much more data that's used in the traditional score today. So it's all about that data that's in the score. And again, the data is different across the bureaus.
If consumers have never had more access to content and information about the mortgage process or the lending process or their own credit data, why are conversion rates low? So if consumers can go seek information about their credit score and financial profile, why are they going to lenders to test the waters if they could potentially get that knowledge on their own?
Well, I think that consumers are shopping, right? Like they do for any product. It's a great thing.
But it's tough for lenders.
It means that the lenders have to have processes in place to be able to do that evaluation fairly quickly. And there's been a lot of tools that have emerged over the last several years that help pre-qualify a consumer without posting a hard inquiry to their report, that allow the lender to have kind of a quick look into whether somebody's probably going to qualify or not. And that goes beyond credit data, by the way. There's income and employment and other solutions that go into deciding whether you're going to be able to underwrite a mortgage loan for somebody that you can look at kind of before you go through the full process. I totally agree with you. In fact, Bob yesterday in the opening session, I wrote down a quote. He said, the supreme irony is that Fannie and Freddie do not use the credit scores. They get data, and then Desktop Underwriter and Loan Processor do their thing. The credit score is used for price. And I think one of the things we're not talking about enough is, well, first of all, I couldn't agree with him more on that. Second of all, it's not just the underlying data. It's the innovation in the technology, in the security, in the consumer support, and how we answer questions for consumers, how we educate consumers, the tools that we give them, the places that we go to be able to communicate with them in a way that's meaningful, For example, Experian has a partnership I'm super involved in and proud of with Home Free USA that helps with Black and Brown communities and getting the word out through means that really resonate with folks. It's about a lot more than data or a score. It's about how you manage it, how you educate about it, how you get it out there into the world.
You mentioned innovation. Innovation is clearly something that's happening, but in the same sentence here at MBA Annual, people are talking about regulation.
Yeah.
Do you see regulation as something that's pushing forward innovation or holding it back? Like, what is this relationship between those two really important topics?
I mean, the three of us have lived in a world where you have to innovate. I mean, financial services is one of the most highly regulated industries out there. And rightfully so, right? Rightfully so. So our three companies have had to innovate within that infrastructure since we started. I do think that sometimes regulation and or, some of the folks who oversee the industry can help that along. For instance, the FHFA's adoption of and enablement of scores like Vantage 4.0 or more modern scores just in general that take into account the data and the processes and everything else that we've been talking about here today. That's going to help because the GSEs needed to be able to accept scores that they weren't accepting before. And so there are times when regulation prompts it.
You've seen all three of us put some of that innovation, some of that value add back into the industry very publicly and committing to do that on our investment to help the industry move forward.
Can you share what's the most important innovation that Equifax is bringing forward right now?
Yeah, so from our perspective, we have a couple of data repositories that are unique, telco and utility and that type of pay service history. The other is our work number. And so we've taken elements from both of those product sets thanks to some of the work we've done on transformation. And we're making that available with the credit for the exact thing that Michelle was referring to, allow people to make better decisions right at application before they spend all of the money to get somebody to a close.
In the spirit of fierce competition, I'll let Michelle and Satyan share their innovation as well. You want to jump in?
Yeah, sure. So, we announced that we're going to continue to add more of that alternative data into the mortgage credit file. Rental, I want to just build on what Michelle mentioned, the leadership from Director Pulte and the FHFA to advance the adoption of scores like Vantage Score. One of his follow-up messages on X was about now using rental trade lines and that being part of what homeowners can rely on. So, we want to double down on that, add more of those rental trade lines to the file as well. And then, short-term lending is another data set that we invested in a few years ago. We have research that shows that, especially for that marginal consumer, maybe the FHA or the first-time home buyer, those consumers that are under a 620 or 650, a short-term lending trade line actually is positive for them. It's not a negative signal, it's a positive signal because, again, it could be the first time they're interacting with credit. So again, we want to help achieve that mission of getting people into homes safely and then in an expanded way.
And in I'm sorry, go ahead.
Yeah, Michelle's turn.
Competition keeps coming out.
Get it back, guys. I totally agree. Experian invested in one of the largest rental databases in the country 10 or 15 years ago called Rent Bureau. But we had to go beyond that because so many folks rent from individual landlords or, not a property management company, right? And so we innovated with things like Boost, which allows consumers to work with their bank account to be able to show they're paying their rent on time every month and permission it themselves into the file. We've got relationships with 80 million people in the United States, and to get them to opt into reporting that or utility information or how they pay their Netflix account and everything can really, really create a file where one didn't exist before. Our most recent innovation that we just launched fairly recently is cash flow attributes and scores so that lenders can augment traditional credit debt repayment with how somebody's actually managing their money on a month-to-month basis. And that augments and adds a tremendous amount of value to who you might want to lend to and how responsibly they're going to pay you back.
Okay.
And one of the things I was going to build on what Satyan said, I think is important is, and what Michelle said, we've competed really hard in the consumer finance space that loves more data. They want all these things we've been talking about. The announcement by Director Pulte about Vantage kind of opened the door to a lot of people in the industry learning maybe for the first time, wait, there's more data that could be here versus what we've been using for a number of years. Yeah. So that door has been open now. And I think that's really valuable to the mortgage industry to start realizing what else is out there.
I think that's important what you just said. That door has been opened in the mortgage industry. Mm-hmm. It's been open in almost every other lending category for decades.
Yep.
Yeah.
That's right. And I think that's the point of we've had to compete. The market enables us to compete. It forces us to compete. And we have been competing. And, I think all of us have stories of, what acquisitions have we made? Which angle do we want to compete on? And it's every day that we go to work and think about how do we differentiate.
It feels like more data is always something that people want. But one of the trends and the talking points I've heard here at MBA Annual is the potential move from tri-merge to a bi-merge, or even situations where a single report could be the solution for lenders. So that's kind of a move to less data. I have a feeling that's something lenders are pretty curious about. Like, is this coming up the pipe? What are the hurdles toward moving toward a bi-merge, and what might some of the risks be?
You're looking at me?
Yeah,
I'll be happy to jump in. So there has been a lot of talk about that this week. And, in some cases that's exciting. In some cases, I'd love to see the dialogue maybe shift a little more to how do we help more people actually get into homes versus a little bit of the economics on the credit side, but happy to have that dialogue. I think it's a very slippery slope. And so I'll actually start in non-mortgage. There's a lot of big lenders in today's world that pull 3 credit files or 2 credit files in the auto space or even the credit card space because they believe that there's differences. And they want to see those differences because they believe it gives them a competitive edge in making better decisions and pricing their products more aggressively. So that is someone that has total choice. They could go with no credit score, no credit file, and they're choosing to buy 3. And we're seeing that more and more in the industry. When it comes to mortgage, it really comes to the lost applications. The whole drive is an economic drive. Yeah. If we're talking about what is the best way to get consumers into homes and to qualify more consumers, it is more data. And I haven't heard anybody really give a solid argument as why that's not true. All of the arguments I've heard have been very much financially based, which I respect. And I think that all of us are working together with the different options to say, how do we help up front on the shopping behavior to control cost a little bit more, but we maintain that very proven safety and soundness on the back end so that the consumer gets the best price possible and that the American taxpayer is backing good quality loans.
And it all ties back to, for a score that scores more people, that takes account for all of this data that we just talked about. Yep. And so I think all of us understand that kind of financial conversation. One of the things, and again, this came up as well yesterday from Stan from Freedom Mortgage, thought he made a great point of the U.S. housing system is truly the envy of the world, right? It's kind of a remarkable way to match capital with people looking to buy a home and getting to a home in a very efficient and a very safe way, right? In a safe way to get people now. What is the average mortgage is well over $400,000. You're getting up to $1 million mortgages. To pay maybe $10, $15 more for credit data to keep that system going seems like it's worth it.
Yeah, I think that, well, yeah, go ahead. You were about to say.
No, I wasn't. I mumbled, well said.
Oh, yeah, okay. I think that it's an interesting time to contemplate reducing the amount of data that you use to make decisions. Because there is so much change going on in this industry right now, in mortgage in general, but certainly with regard to how you evaluate risk. You've got everything from technology changes and AI factoring into decisions and everything else. To introduce reducing the amount of data that you take in to how you've known decisions have been made for the last 20 years or so, I think that timing is really interesting.
I think the timing is tied around coming out of a pretty challenging time period for the industry, and people are hunting for margin. And I think Director Pulte's commentary on X and bringing competition to the market, he's very price focused. I think with the lens of benefiting the consumer and some of these costs do flow to the consumer.
Yeah, I would like to comment though, building on this. In today's world, the lender has the ability, the choice to have one credit bureau, to bring that in and to start the underwriting process. They're not required to have all 3 till later in the process. But what we see from many lenders is they've had that bad experience for a borrower that they got closer to close, got the other credit scores, and they had to go back to that borrower and change the rate. And that's a bad experience for the borrower. It's a bad experience for the lender, and that sometimes results in a lost loan. So we see people voluntarily saying, as soon as I know somebody qualifies and they show me any sign I'm going to move forward, they want to make sure they have all 3 credit bureaus. And that is because the loss of a loan is so much detrimental compared to the cost of getting data to do the loan right. And it also reiterates that they know there's enough variation between our different credit bureaus that it has a high potential of changing when it goes to that final pricing sheet. And so there's choice today, there's options today, and we see people choosing with their pocketbook to buy more data sooner to make sure that the experience for their customer is that lender closes that loan.
Yeah. Are there certain lenders, or like whether we're talking about wholesale and broker channel or the independent bank or depositories that might choose one path over the other, or pulling all 3 out the gate versus a single report? Or is that kind of a lender by lender decision?
Yeah, I could take
trends.
Yeah, I mean, I would say one thing, maybe adding on to what Joel said, is that the consumer experience is really important on the consumer having that certainty and again, getting credit for all of what they've done in their credit file or in their relationship to credit. There's been conversations about other lending lines. Again, Joel said very rightfully so that in other lending lines, multiple reports are used. Also, those are those lending lines that consume this alternative data way more than mortgage does. So it's good to see mortgage moving in that direction. But my point here is that typically a borrower and even their broker or their loan officer may not know exactly right up front which loan product is best for them. It could be a GSE loan, it could be a non-QM loan, it could be a VA loan, right? And I think, again, to be able to cast the net as widely as possible to get the consumer in the right product, taking a look at all 3 bureaus and really using a trended score like Vantage Score is the best answer to get the best option from the consumer.
That's right.
The other piece I would put on that around the 3 bureaus and that is, if we go to one, eventually, like in any area, the models are going to change a little bit. So if you know that the broker is picking the highest score, or you believe that, and you're seeing a 730, you probably eventually will see some of the pricing price that more like a 710 or a 705, because they have to take into account what they're not seeing. So the absence of data punishes the consumer from a pricing perspective. And I think that's one of the risks that we really haven't contemplated. But I will tell you, if you listen to enough of the panels, and there's been a lot of them in the last 6 months on this topic, a lot of our leading lenders are out there sharing that information. They truly want to get the best loan for the customer. And so there's a decent chance they're still going to buy all 3 bureaus. It's just they're going to put the best one forward. So then the overall ecosystem will have to adapt somewhat to that approach.
That's right.
All right, so let's bring this back to MBA Annual 2025. Credit reporting has been a hot topic. One of the breakout sessions yesterday was a complete overflow, standing room only. So it's clearly something people are talking about here in Las Vegas this week. Michelle, can you kick us off with one of the biggest misperceptions that you're hearing here at MBA Annual, or you hear from clients and interactions that you'd like to set the record straight on or bring clarity to?
I mean, I think Joel started off this session with the biggest one, which is that the bureaus don't compete, or that there's not innovation happening within data or the credit bureau industry. Because like we said, mortgage is the only space that requires 3 bureaus to be pulled. We've been competing on that underlying data for decades, innovating, building on top of it, trying to represent the consumer as completely as we can. And so for me, that's the biggest misperception I keep hearing over and over again at this conference.
I think you guys hit the main ones on the point. I did hear an individual stated that 3 credit bureaus is not good for the consumer. And I don't believe that in any way. I think that is a misconception. And I think that's the spirit of the conversation, that more data is better.
What do you think that person's perception was?
I think it was purely financial.
Financial pricing.
Maybe we can save $30 or $40 on that closed loan, which all of us know is such a small drop. I mean, it's less than a percent and a half of the total closing cost. To secure a loan in the most sound housing market in the world seems a little ludicrous at times that we're spending this much energy talking about it. But I'm glad we are. I think, you started this conversation talking a little bit about education and how are we doing that. It's what's become really obvious in the last couple of months is the vast need for education, not only for the consumer, but even our customers.
So on customers, and this is going to be the actual last question, but as we approach a period with lender choice and VantageScore, what do lenders need to do to get prepared? And what moves they need to be making today to prepare for 2026? That seems to be like the head scratcher I do hear pretty often. Michelle, please kick us off and close us out.
I think separately, all three of us have come to the table and said, please, we will give you VantageScore right now so that you can evaluate it in actual underwriting decisions and know how it will play out in your portfolio and in the real decisions you're making over time. The GSEs are going to come out with their guidelines for it here soon, possibly within the next month. And then you'll know how you could make decisions using it. Take the score.
Yep. Go.
Yeah, I would say eyes on the score, like in every aspect of the mortgage process. As Michelle said, we've all made it available. I know that Fannie is starting to add it on the back end in the MBS pretty soon here. So I just think eyes on the score, start to develop that Rosetta Stone with it, an alternative to the score that's been in market for 30 years.
Okay.
And I would just wrap up. I think they've hit it on the nose. So I want to wrap up by saying thank you, Clayton, for helping make this happen.
I'm just proud we had a civilized conversation with three fierce competitors. Joel, Michelle, Satyan, thank you so much.
Thank you.
Yeah.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.